Right, greetings, friends, and welcome to this episode of the Rob Breakenridge Show. Thank you so much for joining us. Obviously, there is one story that is dominating the news cycle right now, and that is the conflict in Iran. All kinds of questions about where this goes from here. I meant questions as to why we're even here in the first place, what the U.S. objective is here, what the end game is here. You know, for all the talk that this is potentially a limited in scope conflict or operation, the social media post Friday morning from U.S. President Donald Trump, where he talks about unconditional surrender, makes it sound like the objectives are much bigger. And the other question, I guess, is how close Iran is to unconditional surrender. No doubt this U.S.-Israeli attack has dealt quite a blow to the Iranian regime, but still I think there's a lot of unpredictability as to where all of this goes from here. And it's all certainly having an impact on global markets, particularly when it comes to commodities, oil especially. We have seen the price of oil rise over the last week, but in particular, as this week draws to a close, we've really seen the price of oil spike. As of Friday morning, West Texas Intermediate is trading at close to $90 US a barrel. And that's already having an impact on gasoline prices, clearly. That certainly is going to have an impact on Alberta's bottom line. Of course, the Alberta government last week tabled a budget which included, despite $13 billion in resource revenues, a deficit of a whopping $9.4 billion. Now, here's the thing. That was a budget predicated on oil being at $60 a barrel on West Texas Intermediate, which, again, is a reasonable assumption because that's more or less where the price of oil has been for the last almost a year. Suddenly now it's a much different equation. In fact, if oil were to stay at these prices, for the coming weeks and months, that could take a big chunk out of Alberta's deficit, maybe erase it altogether. So that certainly changed the dynamic. Look, we've been here before. Rewind back to February of 2022, right, when Russia invaded Ukraine and we saw oil prices spike well north of $90 a barrel, even north of $100 a barrel. That drove gasoline prices way up. In fact, over $2 a liter in some parts of the country. Now, that also gave the Alberta government some flexibility to try to help people deal with those pressures. The Alberta government at the time paused the 13 cents per liter fuel tax, for example. So you do wonder if this becomes a prolonged situation here, even as this maybe alleviates things on the deficit side, is there additional pressure on the Alberta government to help address the affordability concerns that this raises? Now, the other side of it, though, is that this is bound to be a political pressure point south of the border. So far, the U.S. president has kind of been denying that this is going to have much impact on gasoline prices, but clearly that's not the case. He's already been under fire when it comes to inflation and cost of living, and this could exacerbate some of those concerns at a time when Americans are already kind of on the fence or uncertain about the need for this conflict in the first place. So the extent to which that shapes the U.S. response going forward, it is really hard to tell. But no doubt it is having an impact. And depending on how things play out, it could have even more of an impact in the weeks and months ahead. But again, there's all sorts of variables and uncertainties here. But I want to unpack this a little bit further. First of all, though, this is what Alberta's Premier and the Finance Minister, Nate Horner, had to say, speaking earlier this week about the situation, about the impact on Alberta's bottom line. So again, here's Danielle Smith and Nate Horner from earlier this week.
Well, let me just start by saying that we want the conflict to end quickly with minimal loss of life. I think that's what we should all be hoping for. And we're watching with interest about what our friends and allies are going to need. There are, as I understand it, a number of ships that are anchored in the Strait of Hormuz and some threats about not granting passage. And if that occurs, that's going to cause a lot of disruption. But, I mean, we're here to help. But part of the way in which we can help is, of course, with expansions to the West Coast pipelines. The fact that Trans Mountain allows for us to have a clear line of sight to our Asian partners in order to be able to assist them. The fact that there's already an expansion that has been announced, and it just underscores the need for our 1 million barrel a day bitumen pipeline to the West Coast, because if this kind of uncertainty continues, it just demonstrates that the world and our trading partners and allies need to have a stable source of supply, and that's what we are. Did you want to comment?
Yeah, I guess I could comment on what it technically means for the government's revenues, and remind everyone we still have another month of the fiscal year that we're in 25-26. At the Q3 forecast, we determined that in the range that we are predicting, budget 26 and ending this year, that every dollar change in the price of WTI was about a $680 million impact. In budget 25, when we were at a higher level, it was more dramatic. It was about $750 million per dollar. So, since the markets opened yesterday, obviously been watching. It's been between 70 and 74, so a fairly dramatic increase. We'll continue to monitor that. We want to have conservative forecasts. We do want the potential for upside for the province. We don't want to overestimate that to make budget day go easier for myself and the government. I would much rather the actuals at the end of the year be in a better position. But very much the markets are pricing the risk right now. If the strait remains closed for a long time, you'll see that reflected in the price. But as the risk dissipates, it will quickly become a supply and demand calculation again. And, that's what led us to our forecast in the first place.
Do you have a follow-up?
Yes, just on that same topic. The recently announced budget, could this impact that in any way? And when could we possibly see any changes with that as a result?
The budget's printed. We put that out there. We will make adjustments. So like I said, we'll continue to monitor, and we'll give a more wholesome update in August at our Q1 report for budget 2026. You'll get the annual report for the actual year end of the fiscal year that we're in the end of June. But no, we set the budget. That's why we need to have conservative forecasts. And then if we are in a better position, we obviously take that, and if we're in a worse position, we deal with it.
Thank you.
Yeah, the place to look would be the final, because as the minister mentioned, we're still in the last month of Q4 of last budget year. And so in June, we'll be able to see what kind of impact this month of volatility has had. But I suspect, not speaking out of turn, I suspect that rather than a $4.1 billion deficit that we were projecting in the budget, it might be somewhat less than that.
Okay, so both Danielle Smith and Nate Horner being somewhat cautious in their assessment of the situation, understandably so, because this is a constantly evolving and changing situation. But you can do some math there. The finance minister talked about that calculation where for every $1 swing in the price of a barrel of oil, that's about $680 million that it impacts Alberta's bottom line. So if they base the budget on $60 a barrel oil, and we're as of Friday morning, around $88 a barrel, well, you can do the math. That's a pretty dramatic swing in terms of Alberta's revenues. Now, again, there's certainly no guarantee that that price of oil is going to stay there for a prolonged period. But at the same time, there's a possibility that things could go even higher, depending what happens. So to unpack that even further, I want to bring in someone with some great insight on all of this. Rory Johnston is an oil price market researcher. He's the founder of Commodity Context, commoditycontext.com, a really great resource, especially in times like this. Rory, so great to have you with us here. Welcome back to the program.
Thanks for having me, Rob.
So right now, I think I checked earlier this morning, I think West Texas Intermediate trading at, around $78 a barrel, just under 80. So already we're early on to this conflict, but, we were under 60 at the start of the year. So clearly this is something big happening here.
Yeah, so I think it's important to remember for folks that are trying to parse how much oil prices have already responded to this. I think a lot of people were surprised how little prices spiked on Monday. And it's important to remember that prices were already $7 or $8 higher a barrel going into last weekend in anticipation for this. I think It was not a surprise to the overall oil market that something was going to happen, given the buildup of the largest Air Force kind of equipment and military presence in the United States, in U.S. military presence in the Middle East since the invasion of the Iraq War in 2003. So something was going to happen, but clearly this is beyond kind of the market's expectation. And even now, I think given Brent prices kind of in the low 80s, that's high, but not anywhere near reflective of the degree of crisis that the market is potentially facing. I think this is evidence that the market is clearly banking on the fact that this is going to be short-lived. And that remains my bias. I don't think that Donald Trump has the wherewithal, the appetite for a long, drawn-out, messy engagement with Iran. But so far, it's already blown past my initial expectation. So it doesn't look like Trump has yet found an off-ramp in order to declare victory, which is kind of what I'm expecting him to do any day now once he figures out the opportunity to do so.
Well, I mean, especially even just for this reason, right? You've seen over the last year where there have been dips in gasoline prices with oil prices softening. The president has really highlighted that or taken credit for that. So you get into a situation where, and already we're seeing it. I mean, gasoline prices are responding to what's happening with oil prices. That's a real political pressure point, I think, in any context, but certainly here.
Yeah, so like as an example, in Canada, a national average gasoline prices are already up 10 cents a liter. They're up 20 cents a liter so far this year. And diesel's an even more extreme environment and market tightness relative to gasoline. So if you are a business owner with diesel trucks, or you depend, like all of us do, on food and other goods that are delivered via freight, all of that's going to begin feeling this much more quickly than you even see at the pump, because in addition to being a massive, obviously the largest kind of single source of crude oil to the world, it's also a major source of middle distillates like diesel, like jet fuel, to other regions of the world like Europe and Asia. And you're seeing those prices explode. As an example, Singaporean jet fuel, which is the kind of major benchmark for jet fuel in Asia, those prices have already doubled. So relative to, we're looking at $150, $160 a barrel for Singaporean jet fuel. You've seen the refining margin triple or quadruple versus last weekend. So you're actually already seeing the effect in product markets even more aggressively and quickly than you're seeing in crude.
So for now, I mean, we think back to 4 years ago and the Russian invasion of Ukraine, and we were dealing with pandemic pressures at the time too, but that was much more of a shock, it seems. I remember we exceeded 90, we exceeded $100 a barrel with oil. So that was a different situation, right? It's not quite like that, at least not yet here.
Yeah, I think it's actually a really useful point of comparison, because that was, we hit, I think, $120 something on Brent at the peak in June of 2022. Canadian gas prices or pump prices hit their all-time high of above $2 a liter on a national average. I remember filling up at that time, extremely painful. But the important thing to remember going into that was that the market was already tightening prior to Russia's invasion of Ukraine. And we were already seeing prices, skyrocketing up towards $100 a barrel before this occurred, because of the kind of general pandemic bullwhip effect of basically, demand came back much faster than it was expecting, and supply couldn't keep up. OPEC couldn't keep up with those demand increases. This time going in, however, the market was actually much looser. And the big narrative, that kind of the wave of supply that analysts like myself are watching, were keeping prices under deep pressure. But just to put in perspective here, that massive glut that we were talking about was 2 to 3 million barrels a day, which is a big glut in the market. But currently in Hormuz, we've just lost 20 million barrels a day. So 10-fold the surplus that we were seeing even kind of a week or two ago.
Obviously, we've been dealing with Iran for years, and there have been sanctions and various, constraints on their production over the years. So how relevant are they in a global context, and what's the impact of severe disruptions in Iran?
Yeah, so Iran itself is a major oil producer and a major exporter, but it only exports about 1.5 to 2 million barrels a day of crude and condensate to global markets, with the vast majority of that going to China. If this was just a question of Iran, that aforementioned glut I had just talked about, that would have been fine, honestly. Like it would have tightened the market, it would have been positive for prices, but it wouldn't have been an apocalypse. It wouldn't have been the crisis that we're now facing. The issue is not the loss of Iranian supply and exports per se, it's the loss of everything else in the region. And so far, there's been debate about whether or not Iran has actually closed the Strait of Hormuz, and it's difficult to actually physically do so. But given that they have launched, by my count now, roughly 7 attacks over the past 3 or 4 days on tankers and other shipping traffic through the region, the concern is basically of any ship owners trying to transit the area, that they will take fire and that their ships will be lost. So there have been massive spikes in the cost of war insurance, if you can get it at all. But even beyond that, I think, again, back to this idea that like the market doesn't expect this to last that much longer. If you're a ship owner and you can just wait a couple days, that's much preferable to spending an extra $500,000 to ensure your tanker to go across the strait. And I think that's what we're in right now. We're in a game of chicken about how long this is actually going to last.
It was interesting. I mean, you even saw the markets respond when the president was making assurances about covering those insurance costs or just prioritizing keeping the straits open. That sort of calms the markets. But if things go the other way, I mean, what's the impact of that traffic being disrupted? What would be the impact of the straits closing?
I mean, I always shy away from like the big number proclamations in oil because they're thrown around like way too casually. But just to be clear, like 20 million barrels of crude oil lost from the global market. To put that in perspective, the peak of demand loss during the worst months of COVID, the worst demand destruction in the history of the world, during March and April of 2020 was about 10 to 20 million barrels. It's hard to get exact numbers, but it's probably smaller than the amount of supply we just lost right now. And that loss of demand was enough to put prices to negative levels for the first time in history. This, if it lasts a month or two, we're at 100, 150, 200 or more. There is no price high enough that will incentivize enough supply to fill that hole. You would need to basically trigger massive demand destruction globally. And again, when we only lost 20 million barrels at its peak, when everyone was locked in their homes and we weren't flying and nothing was happening, what kind of price would you need to be charged at the pump to basically never drive again? Because that's basically the prices we would need to reach to actually balance that market, which is why I just don't think that the strait can remain closed. Eventually, prices will rise so high that the incentives for making the risky run through the strait will be unavoidable. They will be so appealing that people will start doing it. And people are like, why would you ever make a run through the strait? It seems very dangerous, very reasonable. It's like that Mad Men gif. It's like that's what the money's for. Because there's a tremendous amount of money to be made by those willing to take the risk. And this is a moment of existential crisis for the exporters in the Gulf and the importers in Asia, both of whom are basically staring down the barrel of their doomsday scenario.
Yeah, which is frightening to think. But it's interesting, here at home, the calculations by the industry, because I think they're sort of pricing in what's happening here, but it's not leading to any big investment decisions. I think no one's making those worst case assumptions and saying, well, let's start planning for that in terms of production or infrastructure.
Oh, 100%. And I've been asked a couple of times, like, what can Canada do to respond to this? And the answer, unfortunately, is not much. Not like we have surge capacity. We're not like OPEC. We don't keep spare capacity for a crisis. It's not like we have an extra pipeline, if only, that we were not utilizing. But importantly, I was asked similar questions. I feel like we probably spoke back in 2022 about what Canada could do then. And the answer when Russia invaded Ukraine was also, we can't do much more. But we could have done more in 2022 to better prepare ourselves and our ability to contribute to this crisis today. And that, I think, is this moment that, like, yes, we can't do anything now, but I think, this crisis is the latest example that this market is volatile, that suppliers are unreliable and at risk all over the world, and that Canada's role as a stable, secure supplier gets a massive boon in these types of environments, and it's a massive uplift for brand Canada.
Well, yeah, and you talk about disrupted shipments to China or Asia more broadly. I think that's where Canada is sort of keyed in on right now. And through Trans Mountain expansion, we are supplying to Asia. So maybe that's a potential opportunity to displace some of that, to see that as a market we can build on.
Absolutely. And so right now, for instance, only about 80% of Trans Mountain is readily used because it's a more expensive pipeline, and there's a portion that's uncommitted. Basically, that 80% is take or pay. You have to use it or lose it. So people are using it, which makes sense. But that last portion, which is more expensive, probably about 180,000 barrels a day of capacity to the West Coast, that will likely begin to start being used because those premiums in Asia are just going to continue rising and rising. And it's going to be that much more worthwhile to make the journey from Vancouver rather than going all the way down to the U.S. Gulf Coast.
If we look at Venezuela as a guide here, I mean, it seems like, the U.S. president or the administration is okay with the idea of more or less a regime remaining in place, one that's a little more pliant to American demands or priorities, just so long as they can get the oil flowing once again. I mean, is that a possible outcome here? Does that, you think, help shape the U.S. approach?
That has been my kind of like prior guide to what I was expecting here. And I think, unfortunately, what we've already seen is that we've blown past that as our kind of parallel. That That, and even the episode of the U.S. bombing Fordow and Isfahan and the other nuclear site in Iran with 14 bunker buster bombs last June, that overall, both of those were sharp, explosive, kind of headline-grabbing events that lasted 2 days. And then Trump wrapped it up, put a button on it. And like, for instance, the Monday after the weekend attacks last June from the U.S. on the Iranian nuclear sites, prices jumped on open, which is expected. That was a big thing. But then later that day, Trump basically arranged a ceasefire, and prices were down $10 a barrel by the end of the day. And he bragged about those prices being lower. So that was our prior going into this. But what we've seen I think that Trump is surprised that things have already extended this far. I think he would have expected, once he killed the supreme leader and other members of the Iranian government, that someone was going to come out and say, like, I don't want to die, we'll make a deal. But I think he's deeply misjudged this overlap between, Caracas is not Tehran. There's deeply, deeply different political cultures at play, and Iran does not seem willing to give him an opportunity to make a deal and declare victory. They're very much ready for this for the long haul, it appears.
Right, which is why it's really hard to say sitting here today where this is all going or how long this is going to be. I mean, if we're in that scenario where we're talking about a 3 or 4 week conflict, are a lot of these spikes temporary? Would we otherwise sort of revert back to where we were? I know right now with oil at roughly 75 a barrel on WTI, I mean that would balance Alberta's budget. But I mean, if we have a short conflict, are we sort of back to $60 a barrel territory?
If this had lasted just the weekend, I think that would probably have been the case, or pretty close to. Mm-hmm. And if anything, we could have actually dropped lower because, again, we had already built in this price pressure ahead of time in anticipation of this. So we could have dropped back down to the mid or low 60s on a Brent basis. But I think we're already past that kind of most sanguine view. I've been likening the close of the Strait of Hormuz to basically like the world's largest pipeline, and it's like a kink in a garden hose. If that kink is short-lived and you just open it back up, no harm, no foul, everything just kind of flows back to normal. But there's a couple of things that happens the longer that goes on. First thing we've seen is that basically every day this is not occurring, we're losing basically 20 million barrels of supply from global inventories effectively every day. If this lasts a week, 140 million barrels. It's a lot of oil. If this lasts, a full month, we're talking upwards of 600 million barrels of crude. Even if the supply resumed with no harm, no foul after that, we're restarting the global market with 600 million barrels fewer crude in stocks. That's just going to be structurally price positive for a very long time until we can make up that deficit. But it's also doing other things to the supply on the other side, on the wrong side of the Gulf, if you will. You've already seen reports as of Monday that Iraq was shutting in upwards of over a third of its crude oil production because they've run out of spare capacity in storage tanks and tankers. This is effectively like the supersized version of the Alberta production curtailment that was forced in the beginning of 2019. When you run out of egress, you have to shut in production. And I think that's what we're seeing right now in the Middle East. And it's starting with Iraq because they had the least inventory capacity, but it's going to keep spreading. The longer this goes on, the more complicated that gets. And the one final thing I'll say is, in addition to that kind of building pressure that's kind of shutting things off organically, the longer this goes on, the more you have risks that Iran strikes important oil and gas infrastructure in the region. They've already hit the Ras Tanura oil refinery in Saudi Arabia, which is Saudi Arabia's largest refinery. They've hit the largest natural gas liquefaction facility in Qatar. There are lots of things that are very tempting and explosive targets in the region. We saw Iran hit the Saudi major oil processing facility at Abqaiq in 2019. These are all proven accessible and, again, very difficult to defend targets. But going back to the kind of kinked garden hose metaphor, this is less of a kink in a garden hose, and this is more like taking the shotgun and blowing off the faucet to which the hose has been attached. Everything in the market is repairable, but that's a much bigger repair job that's going to take much longer. So the longer this goes on, it gets worse and worse every day organically, and you just have a higher probability that the thing goes completely sideways very quickly.
Yes. Well, we'll see where it all goes from here. Much more overview, analysis on all of this, commoditycontext.com. Rory Johnston, thank you so much for the insight. Appreciate making some time for us here.
Thanks for having me, Rob.
All right. Thanks once again to Rory Johnston, founder of CommodityContext.com, and a really great overview of where we're at and how all of this is impacting the price of oil and where things could potentially go from here. Do things calm down in the weeks ahead, or do we even see a further escalation? So things seem to be changing by the day, almost by the hour. We'll keep an eye on the situation. There's also the question of Canada's role in all of this. The Prime Minister has taken some criticism for being a little bit all over the map in terms of his response to this, with some initial comments offering support, then seemed to be backing away from that, and really trying to remain firmly on the fence, I suppose, with considerations around not antagonizing the Americans, reflecting where Canadian public opinion is at, and probably just hoping that all of this is resolved rather quickly. Now, at this point, though, Canada has not been asked to do anything, and maybe that pressure ramps up if there is some kind of an expectation here of a broader contribution from U.S. allies, including Canada. Now, what that contribution could look like, obviously, that depends on where all this goes. But this was the Prime Minister speaking earlier this week in Australia, alongside the Australian Prime Minister, again, trying to walk that fine line when it comes to Canada's position here.
You've asked a fundamental hypothetical in a conflict that can spread very broadly. Today's events, recent events, point to that. So one can never categorically rule out participation. We will stand by our allies when it makes sense. There's a distinction between the offensive actions that were taken and are being taken by the United States and Israel, that were taken by them without consultation with Canada, with other allies, and we're not party to those actions. But we will always defend Canadians. We will always stand by and defend our allies when called upon.
Okay, so the Prime Minister talking about supporting Canada's allies, which I guess makes sense, being very cautious about hypothetical situations, which at some point could not be hypothetical. We just don't know where all of this is going. And look, I mean, it certainly remains true, and it's easy enough for the Prime Minister to say that Iran is better off, the Middle East is better off, arguably the world is better off without the theocratic Iranian regime in place. But again, that was true of Saddam Hussein's regime. And even though that regime was removed, that opened up a whole other can of worms. So where does this conflict go from here? What is the impact as a result of this intervention? So it's a story we'll continue to follow in the days and weeks ahead for sure. Much more at our website, robbreakenridge.ca. You can find this podcast, of course, on YouTube, our YouTube channel, Rob Breakenridge Show, and you can find it as well on your audio platforms, Spotify, Apple Podcasts, etc. Folks, have yourselves a fantastic weekend. Don't forget the clocks move ahead to an hour, and there's a whole other debate around whether to keep doing that, which perhaps we'll revisit at some point down the road here. But yes, have a great weekend. We will talk to you next week. Take care. Hey, folks, thanks for watching and listening. You can find us at robbreakenridge.ca. Also, make sure you hit that subscribe button below and stay connected with The Rob Breakenridge Show.